Hello, welcome back to TNC. Today we're kickstarting a new series in this channel focusing on retail investing. So how does someone like you and I, without institutional access or financial backing, tap into the markets? How do we prevent our savings from going idle in a bank account that barely counteracts the rate of inflation? And strategically position them in assets that can give us not only high but also secure returns. Don't worry, this series and this channel are all about answering these questions. This video is the first of a two-part introduction to starting out as a young investor in the early to mid-20s, and why investing young and early is probably the single most important financial decision you can make in your entire life. In the first part, which is this video, I make a strong case for why you should jump into investing now. The second part, which would be released coming Wednesday, outlines 4 important considerations in starting out. Before we proceed, as usual, please give this video a solid thumbs up if you're interested in more videos in retail investing, in personal finance and budgeting, and then hopefully when the whole pandemic situation clears up in credit card strategy and travel, be sure to hit the subscribe button as well so you can get the quickest update and the freshest access to the videos that I will be putting out. So investing, it's a very daunting prospect. There's so many mechanisms and steps involved, right? But that I will save for a later video. What I want to talk about today is why you should be investing. And there are really 5 reasons, I think. Number 1, we all have some form of financial goals, right? So it can be buying a house 2 years into your marriage. It can be gathering enough capital to fund your graduate studies. You might be thinking about having a kid, and that costs a lot of money. You might want to pay off your parents' debt or housing loans. It doesn't matter what your goals are or how far ahead they are into the horizon. Investing your money, of course, appropriate and adjusted to how short-term or long-term your goals might be, is one of the best ways you can achieve your goals on time. Number 2, you don't want to work forever, right? So some of us are quite lucky enough to have jobs that we're passionate about. Perhaps that passion motivates us to get up every single day. Perhaps some of us are less lucky and are working in a line of work where we are okay with it, we put up with it, but at the end of the day, it's something that makes ends meet. Perhaps some of us do love our jobs but want to spend less time at that and more time on other things in life that confer some value to our lives, may it be it family, be it friends, or other pursuits and emotional fulfillments. So the financial freedom, retire early or FIRE principle is something that a lot of people subscribe to. It's something that I believe in. It's something that I subscribe to in terms of putting out the content on this channel. It's something that I try to practice in my own life as much as possible. In terms of saving more, managing my credit cards to get the optimum benefits, making strategic investments, etc. These are all in line with this principle. So nobody wants to work forever, and everyone wants more freedom. And that segues to point number 3, right? You don't want to work for someone else forever. So it is comforting and far more secure to be an employee of someone who's employed by an institution. And certainly being self-employed or without a steady stream of income can be a very terrifying and risky prospect. But what I found since I've started work is the biggest loss for me is really the loss of human agency, the ability to decide for myself what I want to do with my time. So yes, I do love my job and I get a lot of meaning and satisfaction from the work that I do, but perhaps I am luckier than most to begin with. But the realization is that no matter how much you do love your job, okay, your time is still at the beckoning of someone else. I'm not asking anybody to quit their job right now and start their own business, but knowing how to invest the money that you have painstakingly traded the limited number of daylight hours you have every day for, would go a long way in helping you to slowly transition towards that way of living where you are not so reliant on your income stream for survival, to thrive, to a way of life where you are in far more control of your own time and therefore have more freedom for yourself. Now, number 4, you want to diversify your income streams. So this links back to the previous point about relying less on your employment as your sole source of livelihood. So knowing how to invest strategically can also help generate an additional or even multiple income streams at some point that will eventually, hopefully that's the point, right, wean you off employment. So having a steady stream of dividend yields, for example, from your REITs, your dividend stocks, your bonds and rentals, these are some of the most commonly sought after secondary or tertiary or quaternary income streams. But this also acts as like some form of insurance policy. So should something catastrophic happen to you, your employment or your family, like having a diversified set of income streams can lower your personal financial risk and give you a steady stream of money to tide through things. Now, lastly, number 5, because honestly, there are no better alternatives, right, than investing. You can let your money sit and rot in a high interest savings account, such as the DBS multiplier or UOB 360, and accrue an interest that barely matches the rate of inflation, or sometimes during a bear market like the one that we're in right now, underperforms the rate of inflation. What that means is the real value of your money actually decreases over time, and the cash that you're holding on to is losing value over time, despite the fact that the denominations are not changing. Or there are even people who are not even utilizing a high interest savings account. You'll be surprised that people out there who do this exist. And these are the people who are punished even more by inflation. So not investing your money is probably the most surefire way of losing money in the long run, simply because of inflation. So now I have given you 5 good reasons to invest your money. But this video is about why you should be investing your money in your 20s, why you should be investing money right now. While each reason comes with its own little quote, it's a little bit cliche, but I think these quotes remain quite true. Well, the first reason why you should be investing right now and in your 20s is because the saying goes, time in the market beats timing the market. I know it's very cliche, but honestly, it does hold a lot of water. It does matter what you invest in, but what matters even more is when you start investing. As long as you're investing now, as soon as possible, it beats delaying your investments because you want to spend more time to fine-tune and calibrate a foolproof investment strategy, with very complicated investment tools and mechanisms that gives you the best returns. It definitely beats not investing at all, right? So let me give you a scenario. If you were to consistently put in $10,000 every single year into a high interest savings account starting at the age of 20, okay, say at 1.5% interest per annum, you will end up with $560,000 the year you turn 60. So assuming no inflation, assuming no change to your income, and thus no change to the investment amount every year, it stays stagnant at $10,000. Just by moving those investments out of the 1.5% high interest savings account into something that is very safe, for example, like a Singapore-based index fund, right? Or a bond, which on average gives you something like 3% per annum. Just by doing that in the same time frame, right? So from age 20 to age 60, you will end up having a total asset of $786,000 by the time you turn 60. That's almost $250,000 more just by moving it into 3%, just by increasing the rate of return, okay, from 1.5% to 3%. By buying instead a US-based index fund, right, that tracks the market average. So again, we're talking about very safe, very conservative investments. We're not talking about speculative trading and nothing fancy like that. The same time frame will then give you a total asset of $2.8 million, right, which is more than 5 times of what you would have had you not invested at all but instead put your money in a savings account. That's a $2.3 million difference, okay, for essentially doing very little additional work. So this proves that investing and investing in the right appropriate instruments and strategies do matter. Now, what matters a lot more is how early you start investing. So same experiment, $10,000 every single year, but from age 20 to 30, the yearly $10,000 has 0% interest, okay? So that is the equivalent of putting it in, say, a POSB account from your childhood, right? 0% interest. And you only start investing by the time you are 30. So practically 10 years less of investment. Now, the end result, by the time you turn 60, you will almost be $40,000 less if you were investing in a very safe 3% local index or bond. And a whopping $500,000 less if you were investing in an 8% per annum US-based stock index. So this is the power of compound interest. The earlier you start and the larger the compound effect, and the larger the effect it will have on your funds. So for instance, at 8% interest per annum, which is the US market average, again, nothing crazy here, $10,000 at 20 will be worth double, which is $20,000 by the time you turn 30. So in 10 years. Therefore, the money that you invest in during your 20s will be the most impactful and significant on your returns because of how early you jumped into the market. But the second reason is really guided by Warren Buffett's saying, be fearful when others are greedy and be greedy when others are fearful. So why am I advocating investing now or at least very soon in the near future? It's precisely because of this. It's because people are very fearful now. The stock market crashed in Christmas 2018 and then an even bigger crash in March 2020 signify that investors are fearful and anticipating an economic downturn. So one estimate has US GDP forecast for 2020 at -6%. To put things into perspective, during the 2008 Great Recession, the US GDP shrank by 8% that year, and then the -6% forecast for this year is actually very optimistic. It's one of the more optimistic estimates out there. So in a future video, I will discuss more on what is exactly happening in the global economy, what is happening with the US stock market, when and if a bottom will be reached, so stay tuned for that. But the point that I'm making here is that in this decade, there probably wouldn't exist a better time to invest than now, or at least very soon in the near future. If you have capital, you should definitely consider buying soon if you don't start cutting costs, right? So I will link above and below in the description box of a video that I did previously on the 5 most important things you should be doing when you get your first paycheck and before you start investing that money. And one of the, in fact, the most key point that I make in that video is cutting costs, right? Cutting costs so that you can save that money and accrue it for when you want to jump into investments. So that's the end of the video. I hope I made a convincing case for why investing now and investing during your 20s is probably the single most significant financial decision you can make throughout your entire lifetime. And while this video is all about why you should be investing now, the video that I'm going to release on Wednesday is going to be about how you can start investing in 2020 during an economic recession. So stay tuned for that. Once again, if you have enjoyed this video, please give this video a solid thumbs up and share this video with your friends. If you feel like the content I'm bringing out useful and relevant, that will really help me out and help out the channel to grow. And if you want more content like this, be sure to subscribe. Thanks for watching and see ya.